This, of course, brief discussion that we just had introducing the navigation of the site, what's sort of available in some of those sections. Did have a question come in from Terri, it looks like. Yeah, Terri. And Terri simply says, based on that, volatility values you were looking for, is there an edge to look for overvalued or undervalued options? Yes, in most strategies, basically in any of the 23 of the commonly used strategies, there are multiple ways, Terri, that you might consider to look at options that are considered overvalued or undervalued based on implied volatility or based on the Black-Scholes ratio, the theoretical pricing model used for options where the option should be priced. We'll stay with covered calls for the moment, just because it's the simplest one, in the sense that I know all of the criteria are available. But let's say I wanted to look for covered calls next week, but I want to make sure that I'm getting the best bang for the buck. I want a good probability of being assigned. I'm not going to be married to the stock, but I do want a stock in an uptrend. I want to avoid earnings, but I want something that has a little kick into it, that has a little bit of a high implied volatility, and where the implied volatility of the option is greater than the stock volatility, pointing to the fact that it's overvalued. All right. So we'll scroll down beneath the listed results that came up. We're going to go right into the search, but for something as specific as this, instead of using all of the other default criteria we have, I want to look for something that's in an uptrend. I want to look for something that's matching the bullish strategy. We're going to add that earnings not between now and expiration back in. But let's go ahead and clear the filters and start from scratch. What do I want? I want positions that expire next week. So we're going to use all expirations here. And we're just going to put in 0 to 8 days. All right, that's going to cover only through next Friday or anything that maybe has a daily option as well. In each strategy, the setup under the options tab for your options criteria will look pretty much the same. You start off with your expiration time frame. You can even put in your time value or percentage time value if you have that. Whether you want it to go just straight monthly or if you want to use a time frame. Always, if you're using a time frame, select all expirations. If you're looking for weeklies, don't select all weeklies because you'd miss the standard expiration if you're looking 0 to 21 days out in time, simply because that's not flagged on the exchanges as a quote-unquote weekly. So you just want to use all expirations and put in 0 to 23 days, 0 to 24 days. Now we have our implied volatility. And what did we just see a few moments ago on that market statistics page? We saw that the average implied volatility across the market was 0.90. And we know that's going to factor in the election. Maybe the ones that are 1 week out only aren't that high. But let's just put in a minimum implied volatility of 1.00. You could just put in 1 as well, but I'm going to use as 1.00 as we saw. It's based on a decimal. Now, Terri, in this implied volatility factor, we also have the IV over HV. And this is the implied volatility for your option divided by the historical volatility stock as a ratio. So if I want to see things that are at least 20% higher, meaning options where their implied volatility is 20% higher than their historical volatility, we'll just use a ratio of greater than 1.20 or greater than 1.2. Now, IV over SIV is a little bit different. You can still use this, okay? But what this is reflecting is the implied volatility of the specific option that would come up in the search that would meet your other criteria against the stock's implied volatility index. The stock's implied volatility index, or SIV, is the volatility, the average volatility of the in-the-money and out-of-the-money calls and puts for the next 30 to 60 days, I believe. I believe it's 30 days, but it might be 60 days. So it's giving you an average, or what are all the implied volatilities of the options on this same security near term, in or out of the money? And how does your option compare to that? Let's just put this at greater than 1 as well. Now, as I mentioned, I'm going to be a little bit safe. We're going to go about 2% in the money for next week. I'm still going to want about a 0.8% return if assigned on the covered call, meaning if the stock stays above my strike price. And I'm going to want at least a 4 or 5% downside protection. That's just the option premium divided by the stock price in our covered call trade. Of course, how far can the stop drop before I'm technically losing money on the position? So I want at least a 4% downside protection for the next week or so. Now, I mentioned there are multiple ways to do it. In addition to using the IV over HV, We're looking for high implied volatility in the IV over SIV, excuse me, looking for what might be considered high implied volatility or overvalued options. You can also use the Black-Scholes ratio. Now, of course, the Black-Scholes ratio is the calculation that gauges what is the theoretical price of an option. What should the option price be based on 5 factors: the underlying stock price, strike price of our option, our days remaining to expiration, current interest rates, and the historical volatility of the stock. But naturally, we know there are many options that aren't priced at their Black-Scholes ratio. Similar to the IV over HV, Terri, we'd look at this the same way. We'd put in a Black-Scholes ratio of greater than 1.1. It's the actual price of the option divided by what it should be worth. So I want to see something that's 10 or 15% overvalued. So I'll use a ratio of 1.1, 1.15, 1.2 as we did before. And then, of course, you can also use the Black-Scholes ratio SIV, where we're calculating the Black-Scholes theoretical price of the option based on the SIV of all near-term options around it. But, again, near term, of course. So if we're looking at near-term options, we're going to be around the same price, but we can still use that greater than 1. Now, real quick side note, anytime any investor, PowerOptions user, subscriber, trial member, calls up and says, I want to find the most overvalued options. I want to find the options with the highest implied volatility. That's not always the best thing to enter. You want to factor in other details. And one of those subtle details is I want to look for something that has an option bid price of at least greater than 0. Why? Because there's so many options out there that are deep in the money, deep out of the money, that across the exchange might have a bid, well, not in the money ones, but the out of the money ones. If we're looking at naked puts and some of the out of the money naked puts, you have a bid of 0 and just a floating phantom ask of $10. So the midpoint's showing up, let's say, at $5 for something that's 25% out of the money. Well, number one, you probably wouldn't buy that, but number two, you'd never get filled on that position to begin with. Or it has a bid of 0 and an ask of 1 because it's never traded. There's no open interest. There's not been any option volume on it. So those are two things. I'm going to look for an option bid price greater than 0 to filter out any of those phantoms across the exchanges. I'm also going to use an open interest of greater than 0 as well. Now, I got to put in a few more criteria real quick. What did we do? We look for weekly options with a higher than average implied volatility. We saw on the market statistics page that the average implied volatility is 0.9, so we bumped that up 10% higher as a minimum. We're looking for things that are overvalued based on IV over HV, IV over SIV. Percent if assigned minimum of at least 0.8%, at downside protection at least 4%. The implied volatilities we're looking for, that should not be an issue. Also looking for overvalued options using the Black-Scholes ratio as well, and the Black-Scholes ratio SIV. Minimum option bid, minimum open interest. I can put 10 or 15 in there, whatever your preference is. We're just starting off with 0. But since this is a covered call, yeah, I'm going to look for some basic technicals as well. I'm going to look for a stock just with a simple moving average, trading above the SMA 20, for example, since we're using weeklies. I can use RSI as well. Average stock volume, let's throw that in. Average stock volume, this is measured in thousands. So I'm going to put in at least 500. I want to only see stocks that have an average volume of 500,000 shares per day. I would commonly use MACD in this situation, but we're going to avoid that right now just to keep it simple. We are going to go into the fundamentals. Let's just keep a stock price range relative. We'll go $10 to $400 in this case. Earnings per share growth. I want to see something with a good positive earnings per share growth, reflects good management, earnings growth over the last year. We're trying to keep it basic, so let's just keep that simple there. 10 to 400 and earnings not between now and expiration. All right, let's submit our search and see what we've got. No stock combinations meet our search criteria. Okay, so it's probably due to the fundamentals we put in. Let me take out the 5% earnings per share growth. I'm going to leave the no earnings between now and expiration just to stay safe. And let's go to the technicals now. 500,000 is not the issue. I really want to keep the stock above the SMA 20. Let's go ahead and cut that. And there we go. We've got Avis. Avis is not above its 20-day moving average. But Avis right now Let's take a look. I want to go to the research tool real quick. What am I missing here? This is for the 1st of November expiration. It's 7 days away. Both the in-the-money 79 strike and the 77 strike for Avis are offering the downside protection we wanted, a reasonable percent, very high reasonable percent return, and of course now open interest is both there as well. Now, the implied volatility of 1.3 for the November 79 strike, implied volatility of 1.4. What do I not have? I don't have the columns I was looking for, IV over HV or IV over SIV. No problem. Anything that you can filter by, Terry, you can add into the screen. So let's just go ahead and change columns. And we're going to remove some of this. I don't think I need previous option volume. Let's see here. I need all that. I'm just trying to clear some things. I want the implied volatility. Probability assigned, that and that. Range in the money, of course. Option ask, that's good. Previous option volume I don't want. That was for a previous webinar. Percent if unchanged, I'm going to take out. And percent current option volume. Okay, so now, but I do want to add in what we wanted. What did we want? IV over HV. IV over, oops, sorry folks, IV over SIV. And of course, we had the implied volatility already there, check. Okay, and I might even put in the implied volatility range. Now, before I submit this, Terry, I'm going to change the column order because our focus was on your implied volatility. So right after the returns, before probability, let's go ahead and move IV, HV over there. IV over SIV, implied volatility range. I could have added the Black-Scholes ratio as well. I'm not going to do that right now. All right, well, let's go ahead and change that column order there and submit that. All right, so the IV over HV is 2.37 and 2.54 respectively for these two options. And the IV over SIV is 1.44 and 1.54. And as I mentioned, I want to look at the research tool very quickly because it seems like I'm missing something. Normally with these numbers, ooh, that's dangerous. Normally with these numbers, what I'm looking for, oh, I'm sorry, I wanted to go to the stock research. I went to the option research. Okay, that's okay. But here you can see your further detailed information, IV, implied volatility range, and so forth. Sorry about that. Let's go to our stock research page. Fantastic. Well, earnings are unconfirmed at 11:11, but it looks like based on that movement we saw, just on the historical chart of the option, there's some strange move. No, it's just hit a bottom recently and looks like it's about to cross the MACD line. But earnings are coming out the 11th, but we're looking at the 1st of November. So I might want to do some more research on that because this is unconfirmed. But I can't imagine it coming out 10 days earlier before the first expiration. Very interesting. Now, Terry, this is not a recommendation or suggestion. We're going to backtrack on that in just one moment for you. You could do the same thing if you wanted to look for options that were considered in the lower range of implied volatility that were safer. We could, of course, change this to be less than, say, 0.8. Remember, because the average was 0.9. We're looking for 10, 15, 10, 11% lower, excuse me. And look for an IV-HV ratio of, say, less than 0.9. And same with the IV-SIV and the Black-Scholes. But looking for what you had mentioned in relation to the higher implied volatilities and in comparing it to what would be an overvalued option, even though we only had Avis in here that matched the other criteria, I want to put those back in place. We still have the earnings date not between now and expiration. We know we're looking for a stock that's in a downtrend. Now, this isn't to say, keep in mind, this isn't to say that these are the only options out there that are considered overvalued by 20% to IV over HV. These are the only ones that match that other criteria that we put in for the weekly series and the Black-Scholes ratios with a good open or any open interest, and originally we're trading in an uptrend and don't have earnings between now and expiration.